Now the point is what? When a company is selling goods on credit, there is a 99% chances are there that there will be 2% to 5% in general. I'm telling in general. There is a possibility that there are few people become insolvent and that will come turn into bad debt. And we have seen the past for our company, I'm telling you, that there is a almost 2 to 5%, 2 to 5%, there is a bad debt. So in that case, companies follow as per the generally accepted accounting principles how to deal with these bad debts. There is one method, that is, we won't create any allowance account. Here allowance in India we will say is allowance for credit losses. This is in India, that is known as reserve for bad debts or provision for bad debts, reserve for bad debts. The provision for bad debts. So in USA, it is known as allowance for credit losses. So we won't create any provision. So this is not as per the generally accepted accounting principle, and accounting principle doesn't allow to not creation of the allowance account. But anyhow, there are some organizations, they may follow this thing, but is objectionable this is. But still the practice is there for small vendors. But whereas corporate, they will create allowance account. So what will happen if we won't create allowance, if we create allowance, how the treatment will be done, that we are going to do, what that we are going to see now. So first of all, when the sales are made on credit basis, we will record the entry. We know that already, we have discussed. Again, I'm writing to have a sequential understanding. Debit accounts receivable, credit sales. When we create allowance also, in that case also the same entry will be there. Debit accounts receivable, credit sales. So when there is a sale by end of the, it's depend upon the company that it needs to create the, uh, whenever there is a sale is there, so the company will create an allowance. One method, we are not creating allowance, no allowance here created. Here allowance method we are following. So when there is no allowance is created, there is no entry for that one. But this company is creating allowance. Allowance is a contra asset account. Allowance is a contra asset account. Allowance is a contra asset account. So when allowance is created, what should be the journal entry? Contra asset account. So we will credit allowance for credit losses. And debit income statement account and debit credit loss, or we may say bad debt. So in this way, the journal entry will be recorded. So one is effect is going on to the income statement. Another effect is going on to the contra asset account. Contra asset account is nothing but this allowance for credit loss is a contra asset account for the accounts receivable. For the accounts receivable. So allowance for credit losses is a contra asset account. Contra asset account. So it is a contra to the accounts receivable. So what should be the balance sheet treatment and income statement treatment when we do? So normally, if the first entry is recorded in income statement, we will be writing sales 100,000 in income statement, and in balance sheet we will be recording under the assets, current asset, we will be recording accounts receivable 100,000. This is for the sales, credit sales. So further in that particular year, we have created allowance for credit losses. The allowance for credit losses, today itself, we are debiting as loss. Say for example, the company, instead of taking 2 to 5%, the company took 3%. So 3% of 100,000 will be crediting as bad debts allowance. Bad debts allowance. Allowance is created is 3,000. Bad debts allowance will be recorded, or credit loss for bad debts 3,000. Though apparently it is not the bad debt today, but as per the generally accepted accounting principles, that says revenue recognition principle, expenses matching principle is there. What matching principle says? Matching principle says is that suppose in 2020, if you are recording income, expenditure related to this income will be recorded in 2020 itself. Suppose the sales are made on in the month of September, and the financial year closing on 31st March, but actual real bad debts happen on 1st May. So that means 100,000 sales we have recorded in income statement, 100,000, but relevant expenditure, expected expenditure is not recorded under the allowance method if we are not following the allowance method. So this matching principle is violated. What matching principle says? If you are recognizing revenue in 2020, all expenses related to this revenue should be recognized in the same 2020. You can't write 2020 expenditure in 2021. That is wrong. So we have sold in the month of, we have sold in the month of September, but actually the bad debts happened on 1st May. We are closing on 31st March. When we are closing on 31st March, only we have recognized the sales. We have not recognized the bad debts. Why we have not recognized the bad debts? There is no indication from the market, from our data, that this person will become insolvent. But generally accepted accounting principle says, this is a general observation that if there is a credit sales, definitely there are some percentage, minimum percentage of that total sales will be bad debts will arise. That is definitely, that is a definite sign that is there, that is compulsorily. So that's why what generally accepted accounting principle says, though it is not confirmed bad debt, But as per your historical analytics or industry practices, if you started just now, you see the industry. What percentage of bad debts the industry is showing in your particular industry? Take that percentage and create the provision today. This satisfies the generally accepted accounting principle matching concept. What matching concept says? If you are recognizing revenue in 2020, related to this revenue, expenditure should be recognized in 2020. So this expenditure is a probability, not yet confirmed now, but still we know that then when there is a credit sale, there must be bad debts due to some reasons. So if you are a new firm, take the industry average. If you are an old firm, take your past data into consideration and create. So now we created the 3%. When we created the 3%, debit income statement as credit loss, bad debts credit loss, or bad debts allowance to the allowance for credit losses. So allowance for credit loss is a contra asset account. Contra asset account, and this bad debts, bad debts allowance, what we have debited to the that goes to the income statement. That means when you recognize the revenue in the year in which in the same year we are recognizing the possible bad debts loss. So that bad debts loss, that one debit which is decreasing your revenue. Another credit, this is contra asset account. What we will do, the asset account 100,000, the contra asset account credit allowance for credit loss will be deducted 3,000 from the respective accounts receivable, and it will be shown as 97,000. But when you go to the ledger of accounts receivable shows 100,000, and allowance for credit loss shows 3,000. Sorry, accounts receivable shows debit balance of 100,000. Allowance for credit loss shows 3,000 credit balance. When you see individually, the actual accounts receivable are 100,000, and the contra asset account to the accounts receivable shows 3,000. But while showing in the balance sheet, the asset and contra asset will be shown in this way, and finally the net accounts receivable will be shown 97,000. This allowance creation does not permanently decreases the accounts receivable. Temporarily, while showing the balance sheet, asset and contra asset net effect will be shown. So this is the concept of following the allowance method. If we are not following the allowance method, there is no bad debt. So simply we will record debit accounts receivable, credit sale. And when we are following allowance also, the entry is same, debit accounts receivable and credit sale. So when there is no creation of accounts receivable, so in that case, if we are not following allowance method, there is no entry. But if we are following allowance method, debit income statement or bad debts created allowance, that bad debts for allowance for bad debts we can record, and allowance for credit losses. So one is recognized as expenditure, future expenditure, and credit allowance for credit losses, credit account. This is contra asset account. Contra asset account does not decrease any asset permanently. However, the net effect while showing in the balance sheet presentation, we will deduct this contra asset from the respective that asset account. So it doesn't mean, that is the beauty of allowance method. Though it is not permanently decreased, while showing, we'll show the net amount of asset and contra asset, that is 97,000. But whereas when you prepare a balance sheet here, it will be shown just sales and just accounts receivable. There is no bad debts loss here. There is no contra asset account here. This is what the concept of following the allowance or not following the allowance. All of you are following me. If you have any doubt until now, is it clear to you or not? If you have any doubt, ask me.